$88. That is the number that just broke the silver market wide open. Not a prediction, not a forecast from some permabull on a financial podcast. A live price on the screen as gold simultaneously crossed $5,200 per ounce for the first time in history. While the mainstream financial media was busy explaining why the rally would fade, something happened behind the closed doors of the world's most important metals exchange that changed everything. The largest scrap silver processor in China just paid $96 per ounce for physical silver. Not spot price, not futures. Physical metal delivered in hand right now. That is a 10% premium over the global price. And that single data point tells you everything you need to know about where silver is headed next. $100 is not the ceiling. It is just the beginning. For the last 3 years, the smart money has been quietly positioning for exactly this moment. They watched the Silver Institute publish deficit report after deficit report. They watched industrial demand from solar panels explode while mine supply stagnated. They watched central banks around the world accelerate their gold buying to record levels. And they waited. They waited because the paper market at the COMEX exchange in New York was artificially suppressing the price every time it approached a technical breakout level. The big banks would show up with massive sell orders, hammering the price down and shaking out the weak hands who bought based on fundamentals. Wall Street called it volatility. Anyone who watched the data called it what it really was, a coordinated suppression operation designed to buy more time before the physical reality of the market made price suppression mathematically impossible. That time has now run out. And the data coming out of the COMEX exchange right now is unlike anything we have seen in the modern history of the silver market. We are watching the mechanics of a squeeze begin to engage in real time. The slam operations are failing, the physical buyers are winning, and the most important precious metals exchange in the world is quietly, methodically, running out of deliverable metal. This is not a rumor, this is not speculation. This is in the official exchange reports, published every single day for anyone willing to read them. The question is not whether silver reaches $100. The question is how fast it gets there. And based on what is happening right now across 4 simultaneous fronts, the COMEX, China, Washington, and the structural supply deficit, the answer is faster than anyone in the mainstream is prepared to admit. Before we break down exactly how each of these 4 forces is feeding the same fire at the same time, please make sure you are subscribed to the channel and have the notification bell turned on. We are tracking this story in real time, and you do not want to miss the next update. And comment down below, silver or gold? Which one do you believe will give you the better return from here to the end of this year? I want to see where our community stands right now. To understand why the COMEX is now the single most dangerous institution for anyone betting against silver, you need to understand how the exchange actually works behind the scenes. Most people think of the COMEX as a place where you buy and sell silver. That is not what it is. The COMEX is primarily a paper derivatives market, a place where financial institutions trade contracts representing the future delivery of silver. The overwhelming majority of these contracts are never actually settled with physical metal. They are cash settled, meaning the parties exchange money based on the price difference and nobody ever touches a single ounce of real silver. This paper market is vastly larger than the physical market it supposedly represents. For every 1 ounce of physical silver that exists in registered COMEX vaults, multiple paper contracts exist claiming ownership of that same ounce. This is the fundamental leverage that allows large financial institutions to influence the price of silver without needing to hold any physical metal at all. They can sell unlimited paper contracts into the market, driving the price down artificially because they know they will never have to deliver real silver. This is the mechanism behind the slams we have watched play out repeatedly in the precious metals market. A large institution floods the futures market with sell orders, triggering stop-loss orders from smaller traders, cascading the price lower in minutes. The technical damage scares retail investors away, the price recovers slowly, and the institution profits from the short position while simultaneously buying the physical dip at the lower price. It is a beautiful scheme when it works, and it worked for years. But in February of this year, something broke. The slam failed. For the first time in a sustained way that the data makes undeniable, the physical buyers overwhelmed the paper sellers. 23.5 million ounces of silver were requested for physical delivery in a single month at the COMEX. To put that in context, that is an enormous percentage of the exchange's entire registered silver inventory, the metal that is actually available and ready for delivery. Not just eligible, which means it is in the vault, but not committed for delivery, but registered, meaning it is specifically set aside to fulfill contracts. When delivery notices spike to those levels and registered inventories are simultaneously declining, it means the physical buyers are calling the bluff of the paper sellers. They are saying, "We do not want your cash settlement. We want the metal. Give us the bars." And here is what makes this particular moment so historically significant. Among the largest buyers taking physical delivery right now is JPMorgan Chase, one of the biggest participants in the silver futures market. JPMorgan is not taking physical delivery of millions of ounces of silver because they expect the price to fall. Financial institutions do not accept delivery of physical commodities when they think the price is going down. They take delivery when they know the price is going up and they want to own the asset that is going to appreciate. The bank that was most associated with silver price suppression for the better part of a decade is now taking the metal off the exchange floor. That is the most powerful confirmation signal the precious metals market has produced in years. The insiders are not just watching, they are loading up. And while this is happening inside the COMEX, on the other side of the planet, the physical silver market is doing something that defies the paper price entirely. The China factor is the one that should make every silver investor understand that what is happening right now is not a normal commodity rally. It is a structural repricing event. The largest scrap silver processor in the People's Republic of China is currently paying $96 per ounce for physical silver scrap, not for refined bullion, not for LBMA good delivery bars. For scrap silver, the lowest quality form of the metal available in the market, and they are paying a 10% premium over the global spot price of $88 to get it. When an industrial buyer is paying 10% above spot for the lowest grade of a metal, it means one thing: they are desperate. They cannot source enough metal at any reasonable price, and they are bidding aggressively to secure supply before the window closes entirely. This is not a signal about the silver market. This is an alarm bell. The physical reality in China is already 10% ahead of where the global paper price claims the market is trading. That gap does not close by the paper price going down. That gap closes by the paper price going up, and it will close violently. But the story does not stop there. Here is where it gets genuinely frightening for anyone with a short position in silver. The Shanghai Futures Exchange, the largest commodities exchange in China and one of the most important silver markets in the world, was closed for the extended Lunar New Year holiday during the period when silver broke through $88. Chinese traders sitting at home watching the global price move had no ability to react, no ability to buy, no ability to position themselves for what was unfolding in real time. And when that exchange opens again, those traders will see the current price. They will see the delivery data from the COMEX. They will see the scrap premium of $96, and they will buy. They will buy aggressively, because Chinese industrial consumers of silver have been living with a structural shortage for months. They have been managing the deficit by burning through strategic reserves, by paying scrap premiums, by rationing supply to their most critical production lines. When the SHFE reopens and those buyers flood back into the market simultaneously, the buying pressure will compound everything that is already happening at the COMEX. Two of the three largest physical silver markets in the world will be in aggressive buying mode at the same time. This is the technical trigger that the gold-to-silver ratio compression trade has been waiting for. The ratio currently stands well above the historical average. Gold has dramatically outperformed silver in the first phase of this bull market. But historically, silver always catches up, and when it catches up, it does so violently. If gold holds its position at $5,200 and the ratio compresses to historical norms, the implied price of silver is not $100. It is significantly higher. The ratio compression alone could push silver to $120, $130, or beyond. depending on where gold is trading when the compression hits full force. But here is where it gets worse. There is a third front opening simultaneously, and this one involves the most powerful government in the world, and a trade dispute that is escalating out of control in real time. The European Union has frozen the Turnberry Agreement, the trade framework that was supposed to provide a structured path to normalizing tariff relations between Washington and Brussels. The reason for the freeze is the escalating tariff war launched by the Trump administration. And in response to the European freeze, the White House has threatened to impose even higher tariffs on European goods. This is not a minor diplomatic friction. This is the breakdown of trade relations between the two largest economic blocs in the world, happening at a moment when global supply chains are already fragile from years of disruption. And every time a major trade relationship fractures, every time political chaos escalates between economic superpowers, the same thing happens. Capital moves. It moves out of currencies, it moves out of government bonds, it moves into hard assets that cannot be sanctioned, cannot be frozen, cannot be devalued by a politician's decision. It moves into gold. And when gold becomes expensive, the institutions and the millions of individual investors who cannot afford gold at $5,200 per ounce start buying silver. Because silver is gold for the people who are still early to the trade. Because silver is the metal that industrial civilization cannot function without. And because silver is the only monetary metal that is simultaneously a critical industrial input, running at a structural deficit for the 6th consecutive year. The trade war is not just a tariff dispute, it is a confidence crisis. When the world watches the United States and the European Union threatening each other with economic warfare, the central banks and sovereign wealth funds that hold trillions in dollar and euro denominated assets start asking a question they did not ask a decade ago. What is the actual risk of holding these assets? And the answer, increasingly, is more risk than we are comfortable with. So they buy gold. And when they buy gold, the gold to silver ratio compresses. And when the ratio compresses, silver closes the gap in the most explosive way. But there is a fourth layer to this crisis that is the most structurally dangerous of all, and it is the one that the mainstream financial media is almost entirely ignoring. The Silver Institute, which publishes the most comprehensive annual survey of the global silver market, is forecasting that this year will mark the 6th consecutive year in which global silver consumption exceeds global silver production. 6 years. 6 consecutive years of the world using more silver than the mines can produce. For the first several years of that run, the deficit was manageable because above-ground stockpiles were large enough to fill the gap. But stockpiles are finite. They deplete at the rate of the annual deficit year after year, until one day there is nothing left to fill the gap. And on that day, buyers who need physical silver to manufacture solar panels, to build semiconductors, to produce medical equipment, to run the AI data centers consuming power at unprecedented rates, those buyers are forced to bid whatever price it takes to secure supply. We are approaching that inflection point faster than the consensus understands. And the real danger is not the annual deficit number. The real danger is what is happening at the corporate level, at the level of the companies that actually use silver to manufacture the products that power the modern world. Samsung, one of the largest consumers of silver on the planet, has signed direct supply contracts with mining companies, completely bypassing the exchange market. Think about what that means. One of the most sophisticated procurement operations in global manufacturing has decided that it cannot trust the COMEX or the LBMA to reliably deliver the silver it needs. So they are going directly to the source. They are locking up mine supply years in advance at fixed prices because they believe the open market will not be able to provide sufficient physical metal at any price when their factories need it. When a company like Samsung walks out of the exchange market, it does not just remove a buyer, it signals to every other industrial consumer that the exchange market cannot be trusted. And when industrial consumers start believing the exchange cannot reliably deliver, they all do the same thing. They all call the mines directly. They all lock up long-term supply. They all remove their potential demand from the open market. This leaves the exchange with fewer buyers and the same or greater speculative selling pressure. But the physical metal they were supposed to deliver is now spoken for by Samsung and the dozens of companies that follow Samsung's lead. The registered inventory continues to decline. The delivery notices continue to rise. And the paper price suppression mechanism slowly grinds to a halt because the physical buyers keep showing up with cash and taking the metal off the board. Silver is both a monetary metal and a critical industrial input. This dual nature creates a demand structure that has no ceiling during a crisis. When financial uncertainty drives investors into precious metals for safety, silver demand goes up. When the global energy transition accelerates installation of solar panels, which require silver for their photovoltaic cells, silver demand goes up. When semiconductor manufacturers need silver for their bonding wires and contacts, silver demand goes up. When the medical industry expands its use of silver for its antibacterial properties, silver demand goes up. Every single trend driving the modern global economy is a tailwind for silver demand. And not a single one of those trends has a meaningful substitute that can be deployed at scale without a decade of industrial retooling. You cannot run a solar panel on copper. You cannot wire a semiconductor with aluminum. The chemistry does not work. Silver is not just the best option. In many applications, it is the only option. And the mines that produce silver are not drilling new shafts at a rate that comes close to replacing what civilization is consuming. Major silver deposits take a decade or more to bring into production from discovery to first pour. Even if every mining company in the world announced a massive new silver discovery tomorrow, it would not produce a single additional ounce of supply for at least 7 years. The supply side of this market is structurally constrained in a way that makes a demand surge of any magnitude an immediate crisis. Because there is no reserve capacity, there is no swing producer that can turn on a tap and flood the market with additional supply when the price spikes. Silver is extracted from the ground in fixed amounts, dictated by geology, not by market prices. This structural reality is the foundation beneath everything else that is happening right now. The COMEX dynamics, the Chinese buying, the trade war, the Samsung contracts, all of these are the spark. But the tinder has been building for 6 years of consecutive deficits, and the pile of tinder is enormous. This is the moment that the most experienced precious metals analysts, the ones who have been watching these markets for decades, will tell you is unlike anything they have seen before. The difference this time is that it is not a single driver. It is not just investor speculation. It is not just one country's industrial demand. It is all of these forces aligning simultaneously, compressing into the same narrow window of time. This is not an ordinary rally. This is a repricing. And repricing events in commodity markets, when they are driven by genuine physical shortages and structural supply deficits, do not end at round number price targets. They end when the price destroys enough demand to bring the market back into balance. At what price does silver destroy enough industrial demand to close a 6-year deficit? Nobody knows, but it is significantly higher than $88. The math is not complicated. The supply side cannot move. The demand side is growing. The inventories are declining. The price must rise until something breaks. $100 is not the destination. It is a checkpoint. The real destination is wherever the market needs to go to balance supply and demand in a world where 6 years of physical deficit have already consumed the safety buffer that used to exist. Here is what this means for you personally, right now, today. If you have been watching the silver market and telling yourself that you will buy when it pulls back, you need to understand something clearly. The last time the COMEX registered inventory was at these levels and delivery demand was simultaneously at these levels, silver did not pull back. It ran. It ran hard and fast, and the people who were waiting for a better entry point never got one. They watched the price go from the level where they were watching to 30% higher in a matter of weeks, and then they bought at the top in panic. That is not a strategy. That is fear disguised as patience. Your retirement account may be sitting in a diversified portfolio of stocks and bonds that your financial advisor assures you is properly balanced. But that portfolio was designed for a world where interest rates were stable, where U.S. Treasuries were the risk-free benchmark, where the dollar maintained its purchasing power year over year. That world is over. The bond market is no longer a safe haven in the traditional sense. Treasury bonds are losing real purchasing power to inflation while nominally maintaining their face value. The 60-40 portfolio that protected investors for 4 decades is structurally broken because bonds and stocks now fall together in an inflationary environment. And you are paying the price for this broken model every single month, whether you realize it or not. Every dollar of inflation erodes the real value of your bank deposits. Every percentage point of dollar debasement transfers wealth from your savings account to the government that is printing the currency. If you work in dollars, save in dollars, and invest in dollar-denominated assets, you are long a currency that is being systematically devalued to fund deficits that have no credible path to reduction. Silver is not an investment in a company. Silver is not a bet on future earnings. Silver is a bet against the paper financial system. It is a bet that physical reality will eventually override paper fiction. And right now, in the COMEX data, in the Chinese scrap market, in the Samsung direct supply contracts, physical reality is winning. The smart money already knows this. The institutional buyers that have been quietly accumulating physical silver for the past 2 years are not doing it because they like shiny metal. They are doing it because they have read the same data we are discussing right now. They understand that in a world of financial deception, tangible assets are the only honest store of value. They are building their lifeboats while the mainstream financial press tells you to stay on the ship and enjoy the buffet. Most people will be blindsided by what happens next. You are watching the data right now. You have the information that the mainstream does not. You know exactly why this is happening while others will only see the price and wonder where it came from. Here is the part of this story that should concern you most on a timing basis. The technical level that silver needs to close above to confirm the move to $100 is $92 per ounce. Silver is currently trading at 88. The distance between 88 and 92 is not large. And when the Shanghai Futures Exchange reopens and Chinese traders see the current global price and the current scrap premiums of $96, that gap will close quickly and without warning to anyone who is not already positioned. Once silver closes above $92 on a weekly basis, the technical picture becomes clear to every algorithmic trading system, every chart-reading momentum fund, every retail investor who has been watching from the sidelines. The 92 level is the key that unlocks the door to 100, 110, potentially 120 in a compressed time frame. And here's the danger. By the time the mainstream financial media reports that silver has broken above 92, the move will largely be over. They will run the headline after the fact, when retail investors are already reading it and buying at the new elevated price, creating the top rather than participating in the move. The window of opportunity in precious metals markets is always narrowest, precisely when the signal is clearest. The COMEX registered inventory is not going to magically replenish itself. The Chinese scrap buyers are not going to stop bidding $96 for metal they desperately need. The trade war is not going to de-escalate while the White House is threatening higher tariffs in response to the EU freezing negotiations. The 6th consecutive year of structural deficit is not going to transform into a surplus because the price moved up a few dollars. None of the factors driving this move are temporary. They are structural, systemic, and reinforcing each other simultaneously. The question is not whether silver reaches $100. The question is whether you own any before it does. The window is open, but it is closing. So what do you actually do with this information right now? Here are the specific steps that make sense based on everything the data is telling us. Step 1. If you own 0 physical silver, that is the starting point. Not silver ETFs, not silver mining stocks. Physical silver bars or coins that you hold in your possession or in a private vault under your direct control. The distinction matters enormously. A silver ETF is a paper claim on silver held by a custodian. In a systemic stress event, custodians can suspend redemptions, restrict withdrawals, or settle claims in cash rather than metal. That is not ownership. That is a claim. Physical silver in your hand or in a vault you control directly is ownership. Start there. A position of even 10 to 15% of your liquid net worth in physical silver gives you meaningful exposure to the move while keeping the rest of your portfolio flexible. Step 2. Pay attention to the COMEX registered inventory reports. These are published daily, and they are the single most important data point for understanding real-time stress in the physical silver market. When registered inventories fall below a critical threshold relative to open interest in delivery months, the squeeze accelerates rapidly. We are already in the danger zone. Watch the numbers. If registered inventories drop sharply in the next few weeks as delivery demand continues, that is the signal that the move to 92 is imminent. Knowledge is your armor in this fight. Preparation is your shield. Step 3. Watch the gold to silver ratio. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. When the ratio is high, silver is historically cheap relative to gold. When it compresses, silver is catching up and silver holders are seeing their wealth in gold terms increase dramatically. If gold continues its move toward $5,500 as many analysts now project, and if the ratio compresses as it historically does in the late stages of a precious metals bull market, the arithmetic points to silver prices that are deeply uncomfortable for anyone who does not own any right now. Step 4. Reduce your exposure to paper assets that are sensitive to the trade war escalation. If the EU and the United States continue to escalate tariff tensions, equity markets in both regions will come under pressure. Export-dependent companies, multinational corporations with complex cross-border supply chains, and financial institutions with large European counterparty exposure are all vulnerable. Reducing those exposures and rotating into hard assets and commodity-linked equities makes sense in this environment. Real assets do not care about tariff negotiations. Gold and silver do not have a supply chain that can be disrupted by a presidential executive order. Step 5. If you want equity exposure to silver's upside, consider silver royalty and streaming companies as a cleaner alternative to direct mining stocks. These companies have fixed cost agreements with mines to purchase silver at predetermined prices and sell at market rates. In a silver price spike scenario, their margins expand dramatically and their stock prices can outperform the metal itself. Unlike direct mining exposure, they do not carry operational risk, permitting risk, or labor disruption risk. They are the cleanest equity proxy for silver price upside without the volatility of individual mining stocks. In a world of financial deception, owning royalties on real assets is one of the most powerful structural positions available. The data is telling a story that the mainstream financial press is not yet ready to tell you. Silver at $88 is not the top. It is the launch pad. The COMEX is failing to suppress the physical market as 23.5 million ounces of delivery notices in a single month overwhelm the paper sell operations. China is paying $96 for scrap silver, and the Shanghai exchange has not yet had a chance to react to current prices, meaning a wave of buying is locked and loaded for the moment the exchange reopens. The trade war between the United States and the European Union is accelerating the flight of capital from paper assets into hard assets at the fastest rate in years. And the Silver Institute is confirming what the market data already shows. This is the 6th consecutive year of structural deficit, and the companies that need silver most are now going directly to the mines because they cannot trust the exchange to deliver. When you align all 4 of these forces in the same direction at the same time, you get a repricing event that happens faster and goes further than even the most bullish analysts expect. The 92 level is the confirmation. $100 is not a ceiling. It is a checkpoint on the way to a price that reflects the true scarcity of one of the most important industrial materials on Earth. Subscribe to the channel and turn on the notification bell. This story is moving daily, and you need the updates in real time to stay ahead of it. Share this video with anyone you know who holds savings in paper assets that are losing purchasing power every single month. You might give them the most important financial information they receive this year. The algorithm does not favor this kind of hard economic truth, so we need your help to spread it to the people who need it most. You have the data. You have the analysis. You have the information that most people will not receive until it is too late to act on it. The window is open, but it is closing. Together, we navigate this moment of financial transformation and emerge on the right side of the greatest silver repricing in modern history. Knowledge is the only asset that cannot be inflated away. The storm is already here. The data is already clear. And the clock is already running.